Hey everyone, welcome back to the channel. Dividend investing is an amazing way to grow your wealth and generate passive income. But like any investment strategy, it's not without its pitfalls. In today's video, I'm breaking down the top 5 mistakes that dividend investors make, and more importantly, how to avoid them. Whether you're just starting out or already building your portfolio, understanding these common missteps can save you money and help you maximize your returns. Let's jump in. Alright, let's talk about chasing yields. It's really easy to get caught up in the excitement of seeing a stock with a 10%, 12%, or even higher dividend yield. You might think, hey, I put $10,000 in there, and I'm getting $1,000 a year back. That's incredible. But hold on a second, before you hit that buy button, you've got to ask yourself, why is the yield so high? Sometimes, a high yield is a sign that the company's stock price has taken a nosedive. Think about it, dividends are paid out of a company's earnings. If the earnings stay the same, but the stock price drops, the dividend yield goes up. Sounds great, right? Not necessarily. That drop in stock price could be a red flag. It might mean that the company is facing some serious challenges. Maybe their earnings are declining, they're losing market share, or there's some other fundamental issue with the business. Remember, a dividend is only as good as the company that pays it. If the company isn't healthy and profitable, that dividend could be at risk of being cut or even eliminated entirely. Instead of chasing yields, look for companies with a solid track record of dividend growth. So, do your due diligence, look at the company's financials, and make sure that juicy dividend yield is backed by a solid business. Let's talk about the payout ratio, which is one of the most important metrics to look at when you're evaluating dividend stocks. Simply put, the payout ratio tells you what percentage of a company's earnings is being paid out as dividends. For example, if a company earns $1 per share and pays out 50 cents in dividends, its payout ratio is 50%. Seems simple enough, right? But here's the thing, a high payout ratio can be a red flag. Think about it. If a company is paying out a huge chunk of its earnings as dividends, it might not have enough money left over to reinvest in growth, pay down debt, or weather any unexpected storms. And that can be a recipe for disaster. As a general rule of thumb, I like to see payout ratios below 70%. That means the company still has plenty of cash flow left over after paying dividends to invest in its future. Of course, there are always exceptions to the rule. Some industries like real estate investment trusts, REITs, naturally have higher payout ratios because of their tax structure. But even then, it's important to look at the company's track record and make sure they can sustain those payouts. So the next time you're looking at a dividend stock, don't just focus on the yield. Take a close look at the payout ratio and make sure it's at a sustainable level. Let's talk about diversification. Now, you've probably heard this a million times before, but I'm going to say it again because it's just that important. Don't put all your eggs in one basket. This is especially true when it comes to dividend investing. It might be tempting to load up on stocks and sectors with traditionally high dividend yields like utilities or real estate. And hey, there's nothing wrong with having some exposure to those sectors. But if your entire portfolio is concentrated in just one or two industries, you're setting yourself up for potential trouble. What happens if there's a downturn in a particular sector? What if interest rates spike and hit real estate hard, or new regulations impact the energy sector? If your portfolio is overly reliant on those industries, your dividends and your portfolio value could take a serious hit. That's where diversification comes in. By spreading your investments across a variety of sectors, you're essentially hedging your bets. You're reducing the impact that any one company or industry can have on your overall portfolio. Think of it like this. You wouldn't want to own a restaurant that only served one dish, right? You'd want a diverse menu that appeals to a wide range of tastes. It's the same with your portfolio. You want to own a mix of companies in different sectors, industries, and even geographies. That way, if one area of the market is struggling, you've got other investments that can pick up the slack. Diversification isn't just about reducing risk though, it can also help you potentially boost your returns. By investing in a variety of companies, you're increasing your chances of owning some of the biggest winners in the market. So, how do you diversify your dividend portfolio? Well, you can start by investing in broad market index funds or ETFs that track the S&P 500 or the total stock market. Remember, diversification is key to long-term investing success. let's talk about reinvesting your dividends. Now, I know it can be tempting to take that dividend check and spend it on something nice for yourself. And hey, there's nothing wrong with treating yourself every now and then. But if you're serious about building long-term wealth, reinvesting your dividends is one of the most powerful things you can do. Why? Because of the magic of compounding. Compounding is essentially the process of earning interest on your interest. When you reinvest your dividends, you're buying more shares of stock, which then generate more dividends, which you can reinvest to buy even more shares. It's like a snowball rolling downhill, gathering more and more snow as it goes. Over time, even small amounts of money can grow into a substantial sum. Think of it this way. Let's say you invest $10,000 in a dividend stock that yields 4% per year. If you don't reinvest your dividends, you'll earn $400 in dividends each year. But if you do reinvest those dividends, and the stock price stays the same, after just 1 year, you'll own more shares worth $10,400. The next year, you'll earn dividends on that $10,400, and so on. Over time, the difference in returns between reinvesting and not reinvesting can be staggering. Let's say you invest that same $10,000 for 30 years, and the stock continues to yield 4% per year. If you don't reinvest your dividends, you'll end up with around $22,400. But if you do reinvest, your investment will grow to over $32,000. That's a difference of almost $10,000, all thanks to the power of compounding. So, if you're not already reinvesting your dividends, I highly encourage you to start today. It's one of the simplest yet most effective ways to supercharge your returns and build long-term wealth. Let's talk about company fundamentals. Look, I get it, we're dividend investors, we love those juicy payouts. But here's the thing, a dividend is only as good as the company that pays it. You can't just blindly chase yield and ignore the underlying business. Remember, a dividend is not a guarantee. It's a payment that a company makes to its shareholders out of its profits. If those profits dry up, so can the dividend. That's why it's so important to look beyond the dividend yield and analyze the company's fundamentals. We need to make sure the business is healthy, profitable, and has a sustainable competitive advantage. So, what are some key fundamentals to look at? Well, first off, let's talk about earnings. Earnings are the lifeblood of any business. It's what allows a company to pay dividends, reinvest in growth, and weather economic storms. When you're looking at a dividend stock, you want to see a history of consistent earnings growth. That shows that the business is on solid footing and can continue to support its dividend payments. Next up, let's talk about debt. Debt isn't always a bad thing. In fact, many companies use debt strategically to finance growth. But too much debt can be a red flag. It can put a strain on a company's cash flow and make it difficult to make dividend payments, especially if the economy takes a downturn. When you're analyzing a company's debt, look at its debt-to-equity ratio. This ratio measures how much debt a company is using to finance its assets relative to its shareholder equity. A lower debt-to-equity ratio is generally better, as it indicates that the company is less reliant on debt. Another important fundamental to consider is cash flow. Cash flow is the actual cash that a company generates from its operations. It's what allows a company to pay its bills, invest in its business, and you guessed it, pay dividends. When you're looking at a dividend stock, you want to see strong and consistent cash flow. One metric to look at is free cash flow, which is the cash flow that a company has left over after making essential capital expenditures. A company with strong free cash flow is in a good position to pay and grow its dividend. Alright, let's recap the top 5 mistakes to avoid as a dividend investor. First, don't chase high yields. It's not worth the risk. Second, pay attention to the payout ratio to ensure sustainability. Third, diversify across sectors to protect against market fluctuations. Fourth, reinvest your dividends whenever possible to harness the power of compounding. And finally, always analyze a company's fundamentals before investing. Thanks for tuning in. If you found this video helpful, give it a thumbs up, and don't forget to subscribe for more investing tips. Let me know in the comments. What's the biggest lesson you've learned as a dividend investor? I'd love to hear your thoughts. Until next time, happy investing.